Hello traders, and welcome back to another episode of Technical Edge. Order blocks are considered one of the major areas to high probability trading opportunities. But why do some order blocks yield high results while others fail? To provide a suitable answer to this question, we have studied over 1,000 order blocks through different conditions to find out the different features of high probability order blocks that are been respected by the market. We have added new rules and protocols to improve the win rate of this high probability order blocks, and we gathered enough result of over 85% win rate. In today's video, we will explain 1. The basics of order blocks. We will differentiate between high probability order blocks and low probability order blocks. 2. We will describe conditions required for a high probability order block to increase your win rate. So do yourself a favor, grab your notebook, turn up your focus and watch this video all the way through, and if you are new here, don't forget to smash that like button, subscribe and join the Technical Edge family, where we turn beginners into professional traders. So let's start with the basics. What exactly is an order block? An order block is simply the last bullish or bearish candle before a major move that breaks structure. Order blocks are also defined as the last candle which formed inefficiency or a fair value gap. It is said that big players make decisions at these zones. Now we have 3 major rules for identifying a valid order block. 1. It must be identified from a valid break of structure or trend change. A break of structure and trend change gives us information about the current trend of the market, either the market intends to go further in a current direction or reverse. 2. It must create a fair value gap or inefficiency. A fair value gap occurs when the market is volatile and moves drastically, creating gaps between the wick of candles. 3. It must not be mitigated. Order blocks are only valid when they are still fresh and have not been used or mitigated. When order blocks are tapped and used, they are considered invalid. These rules apply to both bullish and bearish scenarios. So now let's identify order blocks on the chart from the definitions and explanation. I want you viewers to pause this video and identify the order blocks on this chart. How many of you have done that? Thank you if you did. Now let's identify them in a bullish scenario. We will start with the first structure to know if it follows our rules. First, was it identified from a valid break of structure? Yes. Price broke through our previous major high with the body of a candle. Second, did this structure form a fair value gap or inefficiency? Yes. As you can see, price formed a fair value gap while causing a break of structure. Third, is this order block unmitigated? Yes, from the diagram price did not mitigated the FVG or order block. So it is still valid. Now the second diagram. Was the order block identified from a valid break of structure? No. Because price closed above the previous major high with wicks of a candle. So even though this order block has a fair value gap and was unmitigated, it is still invalid because it did not meet the complete 3 requirement for a valid order block. Note, if an order block doesn't meet the full requirements, that is 1. Been identified from a valid structure. 2. Possessing a fair value gap. 3. Been unmitigated. It is considered invalid, because the 3 requirements work together to form a valid order block. Now let's identify them in a bearish scenario. We will start with the first structure to know if it follows our rules. First, was it identified from a valid break of structure? Yes. Price broke through our previous major low with the body of a candle. Second, did this structure form a fair value gap or inefficiency? Yes. As you can see, price formed a fair value gap while causing a break of structure. Third, is this order block unmitigated? Yes, from the diagram price did not mitigated the FVG or order block. So it is still valid. Now the second diagram. Was the order block identified from a valid break of structure? Yes. Because price closed above the previous major high with the body of a candle. Second, did this structure form a fair value gap or inefficiency? No. As you can see, price formed a valid structure without forming an FVG. So even though this order block meets the other 2 requirements, the order block is still considered invalid. Note, the bullish scenario and bearish scenario but have different reasons why the order block in the second example is invalid. This is to explain why an order block cannot be valid without the three requirements. Now the trading strategy we use is simple and here are the rules. In a bullish scenario: 1. Identify a valid order block using the rules we identified previously. 2. Set your order at the beginning or tips of the order block. You can use the wick to place your order or body of the candle. The wick reduces your risk to reward ratio, but you catch more trades instead of missing them, while the body increases your risk to reward ratio, but you miss more trades unlike the wick entry. 3. Set your stop loss at the major low of the break of structure. 4. We target our previous major high for our take profit. Same scenario in the bearish scenario. 1. Identify a valid order block using the rules we identified previously. 2. Set your order at the beginning or tips of the order block. You can use the wick to place your order or body of the candle. The wick reduces your risk to reward ratio, but you catch more trades instead of missing them, while the body increases your risk to reward ratio, but you miss more trades unlike the wick entry. 3. Set your stop loss at the major high of the break of structure. 4. We target our previous major low for our take profit. Now during our study, we noticed that some conditions increased our win rate to over 85%, meaning the probability to win a trade significantly improves. So what are these conditions required to increase your win rate? Dear traders, if you have reached this point of the video, thank you for watching to this point. I will be dropping a free tip at the end of this video, and please do not forget to like and subscribe to this video, and if you have any questions, please drop them in the comment section. Our team will do our best to answer them all. Now what are these conditions and factors required to increase your win rate? 1. Market trend and direction. 2. Liquidity. 3. Lower time frame confirmation. Now let's explain the first factor, market trend and direction. We trade accordingly to the trend of the market. If the market is bullish, we only find buy setups and order blocks, because they align with current flow of the market. Now let's dive in the chart. Since price is moving upwards, we look for a bullish order block, place our market order at the wick or body of the order block candle depending on your trading style, and we wait for price to retrace and tap our order. We fix our take profit at recent major high. Now price taps our order and hit our take profit. Same thing in the bearish scenario. We only find sell setups and order blocks, because they align with current flow of the market. Now let's dive in the chart. Since price is moving downwards, we look for a bearish order block, place our market order at the wick or body of the order block candle depending on your trading style, and we wait for price to retrace and tap our order. We fix our take profit at recent major low. Now price taps our order and hit our take profit. Note, traders shouldn't trade against a trend. If price is bullish, you should only be looking for buy opportunities. Same as the bearish scenario. Now let's observe this scenario in the chart. Price is bullish in trend, but created a valid bearish structure as a trend change. Now a lot of traders will short from the order block of the trend change, forgetting we are still bullish in overall trend. So price will tap their other and stop them out, using them as liquidity. Note, always trade with the trend. Trading against the trend is like swimming against a flowing river, which surely means you will drown. The second factor. Liquidity. Liquidity is where money is in the market, and it is one of the core engines moving the forex market. Big institutions like banks and smart money need large amounts of orders to fill their positions. So how do we spot liquidity on the chart? Equal highs and equal lows are example of liquidity. Now let's look at this in the chart. Price formed equal lows after a bullish breaks of structure in an uptrend. We wait for price to reverse back and clear the liquidity, then tap our valid order blocks. Then price will rally up to our major high, which is our take profit target. Same scenario in a bearish trend. When price forms equal high after a bearish break of structure in a downtrend, we wait for price to reverse back and clear the liquidity, then tap our valid order block. Then price will rally down to our major high, which is our take profit target. The third factor. We wait for a lower timeframe confirmation. Now in the higher timeframe price formed a valid order block. We wait for price to retrace back to the valid order block, then we dive down to the lower timeframe to look for confirmation. We wait for a valid trend change to form, then place our order at the order block of the trend change, aiming for the major high of the higher timeframe. Note, all these factors does not ensure a 100% win rate, meaning you will also encounter losses, but you will have a higher win rate. So now let's explore this in the chart. Now let's first know the higher timeframe that works with lower timeframe. We use the daily timeframe for the 1 hour timeframe, 4 hour for the 15 minutes timeframe, and the 1 hour for the 5 minutes timeframe. Now in the gold chart timeframe, price formed a valid break of structure in a bullish scenario. We now identify the order block of the structure. We wait for price to retrace to the 1 hour order block. We now go down to the 5 minutes timeframe and wait for a trend change as our confirmation. We place our market order at the order block of the 5 minutes trend change. We then aim for the 1 hour major high for our take profit. Now for that free tip, you guys can add all these factors together for a much more higher win rate, for I will still explain this more. That's it for today, traders. If this video gave you real value, make sure to subscribe and turn on the notification bell so you never miss the next drop. Share your thoughts or the next topic you want me to break down in the comments. Your support keeps this channel growing and I appreciate every single one of you.